Tesla's third-quarter earnings call on October 22, 2025, presented a story of sharp contrasts. The company announced record vehicle deliveries, which was definitely a positive sign for its production capabilities. This achievement actually helped push revenues up by 12% compared to the same period last year. And this return to growth was notable, especially after 2 straight quarters where revenue had actually declined year over year. Investors and analysts were watching closely to see if the electric vehicle giant could get back on its previous high-growth track. The initial top-line numbers seemed to suggest a potential turnaround was underway for the car maker. However, the good news on revenue was overshadowed by less impressive profit figures. Tesla's earnings missed the expectations set by Wall Street analysts. The primary reason cited for this shortfall was the increasing costs of production and operations. This detail worried investors as it suggested that even while selling more cars, the company's profitability was being squeezed. The market's reaction was swift and telling. In after-hours trading immediately following the release of the report, Tesla's stock price dropped by nearly 4%, reflecting the disappointment and uncertainty among shareholders. The stock market's nervousness continued even as the initial shock wore off. While the shares pared some of their losses, they still ended the session down by 1%. This reaction showed that the market was more focused on the missed earnings and rising costs than on the record deliveries. The results painted a picture of a company navigating a difficult economic environment where simply making and selling more cars was no longer enough to guarantee the stellar financial performance that investors had come to expect from Tesla over the years. The mixed results set a tense backdrop for the rest of the earnings call. Adding to the concern, analysts began to adjust their forecasts for the upcoming fourth quarter. Based on the third-quarter performance and the broader economic headwinds, projections shifted to a potential revenue drop of around 2% for the final quarter of 2025. This was a significant development. It suggested that the challenges seen in the third quarter were not a one-time issue, but could persist. The call, which began with a narrative of record-breaking sales, quickly evolved into a more complex discussion about profitability, future growth, and the immense pressures facing the company. While investors were keen to understand the financial details, Elon Musk had a different priority for the call. He quickly shifted the focus to a massive new compensation plan for himself. Proposed in September 2025, this pay package could be worth up to $1 trillion and would increase his ownership stake in Tesla by 12%. Musk took over the call, even interrupting his own chief financial officer, to make a direct appeal to shareholders. He urged them to vote in favor of the plan at an upcoming meeting in early November, framing it as essential for the company's future in artificial intelligence and robotics. Musk explained his reasoning in a very particular way. He said he needed enough voting control to give a strong influence over the company's direction. This, he argued, would make him feel comfortable building out Tesla's most ambitious projects. However, he also tried to reassure investors that the power wouldn't be absolute. He claimed he didn't want so much control that he couldn't be fired if I go insane. His passionate and somewhat unusual plea turned the standard earnings call into a personal campaign for what would be the largest executive compensation package in corporate history. The proposal, however, has not been met with universal approval. Major shareholder advisory firms, including the influential Glass Lewis and ISS, have recommended that shareholders vote against the plan. These firms advise large institutional investors, and their recommendations carry significant weight. They raised concerns about the sheer size of the package and the potential dilution of other shareholders' stakes. They weren't alone in their opposition. The New York State Comptroller, Thomas DiNapoli, who oversees a major pension fund with Tesla shares, also publicly stated that the plan should be rejected. Musk's reaction to this opposition was characteristically blunt and aggressive. During the call, he dismissed the advisory firms that recommended against his pay plan, calling them corporate terrorists. This fiery language only added to the drama of the call and highlighted the deep division between Musk's vision and the more conventional views of corporate governance. The debate over his compensation completely overshadowed the discussion about the company's current operational performance, leaving many listeners wondering about the immediate health of the core automotive business, while its CEO focused on securing his future control. Instead of dwelling on the current challenges in the electric vehicle market, Elon Musk steered the conversation toward his long-term, futuristic projects. He spent a significant portion of the call painting a grand picture of a future powered by Tesla's technology, particularly robotaxis and the Optimus humanoid robot. On the topic of robotaxis, he spoke with immense confidence, claiming that a shock wave of adoption was imminent. He proclaimed that millions of existing Tesla vehicles could soon become fully self-driving through a simple over-the-air software update, transforming them into a vast autonomous ride-hailing network. To make this vision more concrete, Musk made a bold promise. He stated that a robotaxi service operating entirely without human drivers would be launched in Austin, Texas, by the end of 2025. This was a very near-term deadline for such a revolutionary technology. He added that the service would expand to another 8 to 10 cities during the same period, though these would initially have human safety drivers on board. This focus on a not-yet-realized future business line stood in stark contrast to the lack of detail provided on how Tesla would boost its current car sales. The second pillar of Musk's future vision was the Optimus robot. He reiterated his belief that this humanoid robot could become the biggest product of all time, far surpassing the value of the car business. He described a world where Optimus robots could perform tasks ranging from complex surgery to manual labor, ultimately creating a world without poverty. To build anticipation, he announced that a demonstration of the next-generation Optimus V3 prototype was scheduled for the first quarter of 2026. This focus on a product still in early development served to distract from present-day issues. What was striking about this part of the call was the almost complete disregard for Tesla's core operations. Musk largely ignored the pressing concerns about the electric vehicle business. Questions about stimulating demand, competing with other automakers, and improving profit margins were left unanswered. Instead, he presented a narrative where Tesla was not just a car company, but a leader in AI and robotics on the cusp of changing the world. This strategy appeared designed to keep investors focused on a massive potential upside, even if it meant glossing over the immediate and tangible problems facing the company today. The focus on futuristic visions left a noticeable void in the earnings call. Many crucial questions from investors and analysts were simply ignored. Neither Musk nor the investor relations lead, Travis Axelrod, provided any guidance for fourth-quarter sales or profit margins. This lack of a near-term forecast was a significant omission, leaving shareholders in the dark about the company's expected performance for the rest of the year. Key topics related to the current business were also sidestepped, including any new strategies to boost flagging demand for its electric vehicles. The silence on operational matters was extensive. There were no updates on the production ramp-up of the Cybertruck, a product many are watching closely. The executives also declined to discuss the impact of the recent expiration of a key federal tax credit for electric vehicles, which could affect sales. Similarly, questions about the effect of tariffs on auto parts and other supply chain issues went unaddressed. Even questions submitted by investors about potential new products were dismissed, leaving a sense of frustration and a lack of transparency about the company's immediate plans. Meanwhile, the performance of Tesla's full self-driving system, the technology underpinning the robotaxi dream, remains a point of concern. Despite Musk's grand promises, the system is not yet fully autonomous and still requires constant human supervision. The adoption rate reflects this reality. Only 12% of eligible customers are paying for the feature, which is now called FSD supervised. A prediction Musk made in July 2025 that autonomous ride-hailing would be available to half the U.S. population by year-end has clearly not come to pass, highlighting a pattern of overly optimistic timelines. This combination of unfulfilled promises and a lack of transparency appears to be taking a toll on the company's brand. Interbrand's 2025 Best Global Brands report showed Tesla's ranking had plummeted from 12th place in 2024 down to 25th. The report cited Musk's controversial political activities and a lack of new products as reasons for the decline. As Tesla navigates broader industry challenges, such as weakening demand and increased competition, the brand's erosion presents another significant hurdle. The latest earnings call, with its focus on a distant future and avoidance of present problems, did little to rebuild that faltering trust.